Hi, I'm Mike Cintolo, Chief Analyst of Cabot Growth Investor and Cabot Top 10 Trader, and I'm here with your Cabot Weekly Review, and I'm recording this late Friday morning, as usual, September 16th. So this week has been bad. It's been very bad for the bulls, kicked off by the Tuesday inflation report, which really crushed the market. Today, as I record this, the market's down, not huge, but 1%, 1.5% on a FedEx warning, which is getting all the economic concerns going. So despite the move, I really don't have anything much new to say. Even the last few weeks has been like beating a dead horse. If you're overexposed, if you're heavily invested, if you did a lot of buying during the prior rally or haven't sold or whatever, yes, I think you should be taking some action. Overall, though, I think it's the same environment we've been in. The intermediate term trend, I think now you can say it's now down. It definitely wasn't up the last couple of weeks. The longer term trend is down, and the same goes for most indexes, growth or value, indexes, stocks, sectors, the whole thing. So I think you should be cautious or defensive or whatever you want to call it, holding plenty of cash. I also still see a lot of stocks from a lot of different areas that have good numbers, good projections, liquidity, good stories, that sort of thing, that are holding up well, that certainly look like they've hit their lows for the cycle and could be ready to get going, maybe not tomorrow, but within a few weeks if the market could shape up. Now, obviously the market's not shaping up, but I think it's okay to hold. The point is, I think it's okay to hold some of these resilient names within the context of having an overall cautious or defensive stance in your portfolio. In Cabot Growth Investors Model Portfolio, we haven't done anything the last maybe 3 weeks. We're about 2/3 in cash, but we're holding 4 stocks that are doing okay. They're not setting the world on fire. No one's making any real money here, unless you're trying to jump in and out every 2 days, which is not my game. But we're trying to give these things a chance, and I do think that the longer they can hold up, the better the odds they can continue higher. But you got to have your stops in place, mental or otherwise, in case the selling spreads and hits the things that have meat left on the bone. I have a lot of charts to get into, and I want to, but a couple times a year I usually say this on the bull side or the bear side. When the market's going up for 6 months or 9 months and everything's going crazy, I will say, hey, keep your feet on the ground, take some partial profits, don't chase things higher. Things are extended. It doesn't mean it's a prediction. It's just saying you recognize the environment. Today, it's the polar opposite, where there's, I don't want to say a crystallization of bearish sentiment, but it is very comfortable to be bearish. It's very comfortable and easy to go find a headline that says the market's going to fall 20% further. And they could be right. I'm not saying those predictions are wrong. But what I am saying is a lot of these people making those predictions, were saying something different, 6 or 8 months ago. They weren't saying that, okay? The point isn't, we all live in glass houses in this industry. The point is the market itself is going to be your best predictor. So just keep your feet on the ground, ignore all that stuff. I'm not saying you have to lean against the wind, but just ignore it altogether and just stay focused on what's going on. Today, clearly the sellers remain in control of most stocks and sectors, not everything, but most. So I think you should be heavily in cash and maybe holding 2, 3, 4, whatever resilient names and seeing if they can be potential leaders here of the next uptrend. Okay, speech over. Let's hop into the charts. As always, I'm using a program called MarketSmith. You can learn more at marketsmith.com. It's a product of Investors Business Daily. So here's the Nasdaq. Here was this, this was a 13% decline after this sort of July, August rally. We had a couple of good days, and then this was the Tuesday inflation report that was hot, and the Fed's going to stay aggressive and all this. And then we're dipping here today on FedEx. Like I said, nothing's really changed from my perspective. I mean, I guess you could say the intermediate term trend was more neutral than down. Now it's down, whatever. Either way, it's not up. We're way below the 200-day lines. Our intermediate and longer term trend models are both negative. So that remains the case. And I would just say everything is pretty much in gear in that sense. The S&P, new recent low. Maybe we kind of come down here and retest the June low. If so, we'll be looking at some of the internal measurements. Is there any positive divergences? Are there negative divergences? We'll see how it goes. But everything, like I said, is pretty much in gear. The small caps, below the 50-day line, sort of testing, multi-week lows back here, but still above the lows from May and June. What else? The New York Composite, they all look pretty similar. Even the growth indexes, this is QQQJ. A little bit, I have noticed some of these are very, 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 very minor relative strength, meaning they haven't undercut that low from a couple weeks ago, whereas most indexes have. But that's, that's too short term for me. Same thing here, IPO fund, IWO. Everything's pretty much in gear in the sense of the trend below the 50-day lines, below the 200-day lines, that sort of thing. If you want to say there's a little relative strength here, that's fine. But that's about the extent of it. Back to the Nasdaq, yeah. Oops, sorry about that. Back to the Nasdaq here, if it wants to come. Okay, here we go. It wouldn't be unusual. Usually when you get these big declines, the last couple of years you had the pandemic and you had the 2018, the fourth quarter, which was China trade war. The Fed was sort of somewhat aggressive at that point, and the market fell 20-25% in the fourth quarter, and then we just kind of bottomed and took off, okay? Usually, though, what you end up doing is getting a bottom being a process. And you could say that process in large part has started in May, and we're still in it. Now, does that mean the market, if it comes down here to 11,000, say on the Nasdaq, it's a great buy? No, like we could just easily cheese through these lows. 10,500 was the prior low. And this could just be a whole new third leg down. But if we approach those lows and as we approach those lows, how the market handles itself will be pretty key. It's not unusual to get a retest. I'm not trying to make this week, be fine or whatever. I'm not trying to wish it away, but I'm just saying retesting the low after a 35% bear phase in the Nasdaq is not unusual. That's really more the norm. So if it happens, we'll have to see if support holds or if we just cheese through it or what. Okay, right now, the good news is you don't have to know, you don't have to guess. You just have to follow along. And right now the trends are down for a lot of things, so just stay cautious, okay? Digging deeper a little bit, just a couple things I'm pointing out. I'm not trying to make it into bullish or bearish or whatever, but this is XLY. I don't look at these too often, but this is consumer discretionary, so not staples, which I'll show you in a second. It's not toilet paper, toothpaste, and all that. It's, it's cars, it's stuff you want to buy, not stuff you have to buy, right? And it's just kind of interesting. I do think Amazon's a little heavily weighted in here, but, excuse me, it is holding up a little bit here short term. Again, I don't want to make too much out of this because you come in tomorrow or later this afternoon and, it's way down here and it doesn't matter. But it is just in general, it's still hanging around the 50-day line. Even when you compare it to the consumer staples, which you think would be better. I guess there's some, US dollar stuff there I mentioned last week. But this, the staples you think would be more resilient than discretionary, but they're not. So I find that kind of interesting, okay? The other thing I just noticed in recent days, again, not going to make too much out of it, but this is the XLF, which is financials, which is famously not a leading group in terms of what you want to buy, like leading stocks, but it can lead the market higher or lead the market higher or lower ahead of time. And again, there's a little bit of minor relative strength here, and just the overall picture of it over the last, really this part is just a little bit stronger than the major indexes. So just something I'm noting. Okay, on the flip side, I would just say for the growth investors, I pay more attention. This is the Semiconductor Index. This one isn't that far from retesting its low. And again, doesn't mean this has to be, this doesn't have to be the leading group or anything like that. But usually when chip stocks are doing well, it's better for growth names in general. So that's sort of a minor negative, but just digging in a little bit, you can see it. Another thing I just want to say, it's sort of obvious here, but if you're looking at individual stocks, and I'm going to get to many that are acting well, you're still just seeing a lot of selling on strength, okay? And it's not a surprise given the environment. But so this is Uber, which is something I'm watching just to look at the weekly chart. It went through the ringer, not just this year, but really the last couple of years. Not a huge bottoming process, but this earnings gap with the expectation of further profits, or at least EBITDA, it may have changed the stock's character. Anyway, the point is it's been acting well. It comes under accumulation here, and then it kind of quote unquote breaks out. But breakouts in a bad market are actually very low odds plays. The reason I'm bringing this up, and you can see it's getting hit today, it still looks overall okay, like it's in this bottoming formation. But my point is, if you do want to nibble on some of these, do it on dips. And if you miss a stock because it's breaking out and running, chances are that's going to be a good sign for the market, and there's going to be many more that can break out and run, okay? But we're not in that environment yet. What was another one? Oh, Academy Sports, ASO. I think I mentioned this in last week's video. I do like this hold. There's like a cookie cutter aspect here. It's cheap as hell, and it's got this sort of big, really its first base, its first launching pad here. But again, it reacted well to earnings here on the daily chart, runs up, gets over this 50 resistance area for a day, and then it immediately pulls back. Looks totally fine. I mean, I'm not saying it looks bad at all, but the point is, if you're going to buy these things, if you're going to buy them, nothing wrong with watching them, but if you're going to buy them, try to do it pullbacks into moving averages, use some sort of reasonable stop. If you get excited because the market's up 3 or 4 days in a row and you're chasing something higher, chances are you're going to be underwater on that pretty quickly. So just something to say. Into the stocks, okay. A bunch of things I want to mention. So this is natural gas still looks better. Chesapeake Energy, to me, CHK looks like, I think it's the leader in the group. I know it kind of goes back and forth between it and a couple others. Kind of a consolidation here. One of my thoughts is natural gas stocks do look a little earlier stage than oil. They might just swim together. If oil cracks or oil goes up, they might just pretty much all swim together anyway. But I don't think this is like some of the oil plays. CHK looks pretty good. On the oil side, I still like this CHRD, which is CHRD. But again, this kind of came out of bankruptcy back here. Then there was another merger. It's a long story, but this is not this sort of consolidation in here. Relative strength looks pretty good, but it's choppy, number one, and number two, it's had a big run. So could it work? Yes, it could work. We still own an oil stock in the model portfolio, growth investor. But, you want to be trailing your stop and just be aware that these things have had bigger runs. So far, CHRD I do think looks pretty good. That's why I'm mentioning it. You can see it's getting hit today. But overall, this sort of consolidation, maybe it goes on for a bit and you end up getting sort of a nice tighter structure in here. But CHRD is one to watch. Solar still acts well. I don't want to just run through everything. First Solar is just, I don't know. It's just, there's just a lot of accumulation going on. You can say what you want about the numbers and all this, but it's big, it's liquid. Clearly, Perception has completely done a 180 here. And it did have a nice bottoming phase, but clearly, Perception has done a 180 since the green energy bill. And to this point, hey, listen, maybe it comes in here and collapses, but you can see today it's up a couple bucks so far. So it's just, there's really been no appetite to let go of any shares there. Some of the smaller names are still acting well. This is Shoals. Yes, it's pulled back, but you can see it better on the weekly chart. You have this kind of crash. I wouldn't say a bottoming formation, but it finally gets ahead of steam here and really hasn't done anything wrong. It's just testing the 10-week line this week. STEM is more of a software play in the industry. Again, this is another one that quote unquote broke out on the upside, but immediately pulled back in. But you can see it's not pulling in much. Still looks pretty fine. This is STEM. Shoals and STEM they're less liquid, they're lower price, they're going to move around more, so they could crack. For Solar's more one of the liquid leaders in the group, but overall Solar still looks good. Chip stocks, like I said, most, just to run through, like ASML, this was the big lithography, I think it was, player, and you can just see it's just been in a downtrend, and it's well above its lows, but nothing doing, still way below the 200-day low, 40-week line and all that. But there are a couple names, and I've mentioned them here before. This is on Semiconductor. Okay, you kind of had this sort of 3 legs down, 6 or 7 weeks up in a row. That's kind of a clue, by the way. And now you're in the 4th week of a consolidation in here that's pretty reasonable. Now, on the daily chart, if you own it, you're like, hey, this doesn't feel reasonable because it's just all over the place. But you can see just holding the 50-day line to this point. Can it crack? Sure, but so far so good. And Global Foundries, GFS, which is another IPO, it's getting close here to support. But again, so far it's been 5 weeks in this sort of consolidation. No volume down here, no selling volume. Doesn't mean it can't crack. Doesn't mean the market can't pull it down. But so far it acts well, especially after this sort of whoosh right off the bottom. Not to go on a tangent, but just one thing that kind of pops in my mind is, one of my old rules, it depends on the market. Like in 08, it's a little different. Obviously, that was extreme, and maybe it won't be this time. But if you get a stock that corrects, usually it's 40% or more. But if it's like 45, 50, 60%, and GFS, I think this was basically 50%. Yeah, 80 to 40, call it. Well, when it rallies up, that's nice. It rallies for a few weeks, and that's great. And if you played it, that's fantastic. Usually what happens is if there's a rest period in here because of the depth of the base, it ends up being a base in and of itself. What does that mean in plain English? Usually it's going to take 4, 5, 6, 7, 8 weeks sort of thing. If it works, maybe it just fails. But if it works, these sort of consolidations like you're seeing with this and with On Semi, this is 4 weeks at this point. They usually end up being almost like a base in and of itself, as opposed to just like a 1 or 2 week rest. That's usually not enough rest period after such a big percentage move off the lows. Okay, and so far, obviously, both are holding up well. So I do see some strength in the chip group, but most names, it's still it's not my favorite area out there. I'll put it that way. GitLab, I just mentioned this because there was a few stocks. I like the story a lot. The growth is great. This is a software IPO, got destroyed, huge volume support. I've mentioned this before. There's buying in here on the weekly chart for sure. And at some point, I think this is going to have a pretty good run. I think it can be some sort of leading stock. What's interesting to me is that it had this rally up here. It's probably easier to see on the daily chart, maybe. Yeah. You had this rally up to $70, call it, and then it really just fell apart. It had a sharp pullback, bounce, and then this wasn't even on earnings. This was just, I don't even know what it was, a bad day in the market, and the stock fell like 15, 20%. All in all, the stock fell like 35% in 2 or 3 weeks, and I just crossed it off my watch list and didn't even pay attention to it. They happened to report earnings a few days later, and it popped. People emailed me. I said, don't worry about it. It's just back to where it was. Not a big deal. But it's kind of marched all the way, not all the way, it's marched a decent amount of the way back, okay? I'm seeing some of these things that could be potential shakeouts. It still has work to do, but again, you're kind of in, this isn't nice and tight, but this is the 5th week of a consolidation at this point. Let's see if GitLab, GTLB can kind of round out a little bit. Sort of in a different but similar thing as these IPOs. This is Duolingo, DUOL, a little thinner, but again, you can just see a very nice bottoming effort here. And again, as these things come under control, if they're coming under control, you tend to get a little tighter. They're not going to be, it's a smaller stock. It's not going to be super tight or anything like that. But you can just see all this buy. I think this was a share edition, but still, you can just see the support. Even this week, the stock is flat as I record this, and the Nasdaq's down 6% or whatever for the week. So, now you're in, a couple months here in consolidation. If the market can get going, let's see if some of these things can let loose on the upside. Just something I'm keeping an eye on. I do like that story. In restaurants, this is one I'm not watching, but this is Sweet Green, just to show you that there's a lot of stocks. This thing went from, it got killed, of course, but it went from 10 to 20 or whatever, but it's been holding the 50-day line here. It's been respecting the 50-day line even during this decline. You actually had a little accumulation here. Am I going to go here? No, it's below the 200-day line and everything, but let's just see. It just looks like it's kind of sold out. I've mentioned Chipotle before. This is obviously more liquid, but the stock, well, it's easier to see on the daily chart. The stock had this run, pulled back with the market, and when the pressure came off, it hit a new high. Now it's pulling back again, but to the 25-day line, it looks fine. Wingstop. Wingstop looks great. Again, huge decline. This thing got messed up by the pandemic, both good and then bad. But big rally here. Sharp pullback to the 50-day line, and not only did it hold, which is fine, but really just, it wasn't just that it held and didn't break. It really, they piled into the stock, hit a new recovery high, and again, it's pulling back here, but looks like it doesn't want to go down. It's just being pulled down by the market. Biotech, there's some names. Some of them are news-based. This is Regeneron, which is a big player in the group. You can see, just like a lot of these names, it hasn't done anything in forever. This is a weekly chart. And then last week's volume was the heaviest since September, or I guess, September of October of 2020, whatever. It's big volume, okay? So it popped on news, and so far it's just holding firm despite the market's shenanigans. Okay, Alney Lamb. This one had a big move on a trial result, and don't get me wrong, 240 to 200, back to 230, back to 200, so we've had this in top 10. It could, if it drops in here, it could be a little bit worse for wear. But overall, the stock is holding up fine. You can see right here, again, 5th week of a consolidation. After this move to new highs, it's a speculative play. It's not making any money, but interesting. Neurocrine Biosciences, NBIX. Again, this thing comes down, hits the 50-day line this week. This thing isn't, straight up or anything, but this is kind of a, base building effort here. Here's your breakout. And it's holding, you can see buying the breakout, it's not like you made any money, but holding that breakout so far is pretty important so far. Found some support here this week, last couple of days, so that looks pretty good. And last but not least, this is one I mentioned in Growth Investor last week. I'm not sure if I mentioned it in last week's video. This is Shift 4, payment operator, a little bit thinner, smaller, $4 billion market cap. But nice choppy run, and then, of course, gives it all up here in the bear market. But again, kind of like Uber, it sort of had this, I don't know, there's something about it, just acts, it looks like it's done going down. Maybe not, we'll see. It's still battling with a 200-day line. You can see every time it approaches it, it pulls back. But it's, again, while the market recently has done, I should have the chart up of the market in concert with this, but, 13% decline in the Nasdaq, that's what happened here. And then the Nasdaq bounced for a few days like this, and this almost came back all the way to its high. And now, of course, the Nasdaq's back down here, and this is resisting. So, it doesn't mean, it's not for sure, but you're just seeing more and more of these names just leave some breadcrumbs for you that say, hey, I don't really want to go down. Now, we come in next week and the Nasdaq falls 10% on Monday. I mean, I'm not anticipating that, but if something like that happens, who knows? I mean, all bets can be off. But so far, you are just seeing test after test after test, bad news headline after bad news headline after bad news headline for the market that is affecting a lot of these things. It's affecting the mega cap stocks. I mean, Microsoft, new low, almost, well, not quite, but almost a new low here. Google, I think, did hit a new low, didn't it, this week? I think it nosed out to like a new correction, bear market low. So some of the big things, Meta looks terrible. Some of the big cap, mega cap names, new low on Facebook or Meta, whatever. Some of those things are getting hit, but while you're doing that, you are seeing more and more of these small, mid, sometimes big cap players resist it. So I think it's okay to hold on to some of those, but it's never wise just to look at 2 or 3 or 10 stocks and say everything's fine. We're still in a downtrend. The market's going to have to find support. And at the end of the day, until the market can kind of get up and do this, it's going to be hard to really make any money. So I still want to do, I think, more cash than stocks, at least if you're running a growth portfolio. But just, keep your feet on the ground. Don't listen to all the bad news. Just stay flexible and stay focused on the market. It will tell you when it's ready to get going. Maybe that's next week. Maybe it's in a month. Maybe it's in 4 months. We'll find out. But just stay flexible and, optimistic in your mind that things will turn around. There'll be some leaders to jump on. Okay, that's all the time I have for today. As always, thanks for listening, and come by again next week for another Cabot Weekly Review.